Prime Minister Boris Johnson has stuck to his Brexit promise that the UK will be out of the bloc by the end of the year, and he has repeatedly refused the EU's plea to extend the transition period. Time is now of the essence. A trade deal needs to be finalized by October so it could be ratified and in place by the 1st of January. The EU's chief negotiator Michel Barnier admitted there were still significant divergences between the two sides only last week, while EU figurehead Angela Merkel has warned the bloc to prepare for no deal. As Brexit talks have been struggling on, the euro has shot up to 91p in value and the sterling has been sinking. Yet, both the UK and the EU will be keen to lessen the economic shock of Brexit, especially due to the inevitable coronavirus-induced recession approaching, and so a last-minute agreement could be struck. Writing in the Irish Examiner last month, economist Oliver Mangan explained what a new deal could look like and why the euro needs it as well as the pound. He said, "It looks like it will be just a minimal trade deal, largely focused on avoiding the imposition of tariffs and quotas on goods. It is unlikely to extend to the services sector, the main export engine of the UK economy, most notably financial services. It will be a pale shadow of the current single market and, indeed, the comprehensive free trade deal that was promised at the time of the Brexit referendum in 2016. Yet, he added, even a minimal trade deal would limit the immediate economic shock of Britain leaving the single market. Ireland is particularly vulnerable to the changes Brexit will bring, as the UK is its nearest neighbour and one of its largest trading partners. The Emerald Isle also uses Britain as a bridge to transport its goods to the rest of the EU. Without a deal, any Irish produce travelling through the UK would be marked as third-party freight, slowing down the trade process immensely." Mr. Mangan remarked that in this case, half a loaf is certainly better than none at all, in terms of securing a Brexit agreement. He continued, even a bare-bones trade deal should allow sterling to recover some of the ground it has lost since earlier in the year. The pound and the euro have both bounced up and down in value since the EU referendum, but as Mr. Mangan exclaimed, without a trading relationship and with the UK's departure from the single market, the growth of the economy over the medium term will be inhibited. The economist added, thus, the euro may only fall back to around the 87p-88p level, above the 83p, 85p range it occupied in January and February. A study by the United Nations released in February also found that Ireland will also be hit harder than any other EU member state and the UK by Brexit. It concludes that, in the event of no deal, the tariffs on Irish goods could see a decline of €2.4 billion, £2.167 billion. The Irish Independent explained in February, the rationale behind higher losses for Ireland than for the UK is that Ireland is a much smaller and more open economy than the UK and therefore relies to a greater extent on trade. Katie Martin wrote in the Financial Times back in October, if Brexit goes badly, the currency could take a beating. But the currency in question is not the pound, it's the euro. A chief economist at PineBridge Investments, Marcus Schomer, told Ms. Martin that the European market could be heading towards a nasty fall. He said that both the UK and the EU would be forced to the negotiating table by market meltdowns, because that's how Europe works. Ms. Martin also explained how if no deal is reached, stocks will crash either side of the English Channel. Despite writing prior to the withdrawal agreement being struck, the risk of no deal is still hanging in the air 9 months later.